Well, this week we've got plenty of tariff uncertainty and markets are continuing to drift higher. So hi there everyone, welcome to the Traders Circle Weekly Market Update. It is already the 2nd of June 2025 and before I get started you do need to be aware that whatever I say is general advice only. So we've got a pretty on-again, off-again situation with the Trump tariffs and the trade war. Obviously, he repealed or lowered the tariffs on China back to about 30%. That was a few weeks ago. Just under 2 weeks ago, he announced tariffs against the European Union, and 2 days later, he basically delayed those. And then we've also seen a lot of his remaining tariffs. Basically, a US federal level court announced that he didn't have the authority to implement them. So now, on appeal, those were sort of basically allowed to be put back in place until the issue was decided, but it leaves investors scratching their heads. Can they rely on these tariffs? Are the tariffs being put in place? Will the tariffs remain in place? If you're an importer, I don't know what you're doing. Do you order your goods from Europe or China, or do you order your steel or aluminium? Do you wait for the tariffs to be resolved? It basically leaves one scratching their head about what to do. Some might say this is all master strategy from a great deal maker. And that might be, the case if you're running a business or, a certain type of business and you can try and use all this chaos to achieve favorable terms for yourself. But, a global leading country is not a business. You can't run the US economy like you would maybe a real estate trading company. It just isn't the reality of things. To be honest, it looks, I don't want to use the word amateurish, but it looks like there's not a whole lot of strong leadership at the top. It doesn't inspire confidence in investors. It doesn't inspire, confidence in the US as a reliable trading partner or ally. And I don't think it's going to end well. I don't think that, the Trump economic policies will end well. And ultimately, I'm not sure if he's going to see a full 4 years. I think it could get to a situation where enough public opinion has turned against him that his fair weather Republican allies also turn against him. I think there's plenty in the Republican Party that are waiting for his approval to drop low enough to basically start to go against him as well. So the latest tariff news is basically that we've seen an increase in tariffs on steel and aluminium from 25 to 50%. Now, these ones I think are probably more likely to remain in place. I think, Trump is a pretty sort of the mindset that strong companies make steel and aluminium. So I think these are likely to remain in place. Again, unless there is some sort of exterior challenge to them from a court or something like that. But yeah, I just want to highlight that all this uncertainty, obviously markets are remaining resilient in the short term, but it's not good for the economy. It's not good for the economy in the medium to longer term. We're starting to see the effects of the trade war be reflected in economic data. It doesn't look good, and I think it's going to continue to weaken from here. We did see the first projection start to come through for second quarter GDP. And it is starting to show that the quarter will see positive economic growth for the US, but that's basically because we saw a ton of front-loaded imports into the first quarter. Now, they did have negative growth in the first quarter for that reason, and if the imports do remain low in the second quarter, it might mean we get a slightly positive second quarter. But I would just say that the forecasts aren't that positive, and there's a real chance that the US economy shows a technical recession in the second quarter. Obviously, we're quite a way away from the data coming through. We've still got another month of the quarter to go. And even if it does show negative growth, the US economic agencies are going to claim that it's not a recession. But I do think the US economy is teetering on the brink of a recession, dependent on that data. So that'll be another thing to watch in the coming months. And it is all triggered by this trade war chaos. So yeah, this was a chaotic section covering a chaotic point, and I do think definitely something to watch on that front. It will be a big week of data. We've got Jerome Powell speaking tonight. He's probably going to reiterate his recent comments about potential for stagflation, sticky inflation, yet weakening economic measurables. the market sort of did see a little bit of selling the first time he mentioned this. The last few times, though, it hasn't been too impactful on the market. Market remains pretty happy to keep buying up shares, buying up equities, and pretty much buying up any risk asset, gold, Bitcoin, probably property. And the reason for that is that we're seeing huge amounts of money printing, currency is being devalued, and so it's not really that assets are moving up in price, it's more that money is moving down in price. And we can see an analog of that when we look at US government bonds. US government bonds are in some ways equivalent to money, and the value of those bonds is being pushed down rapidly as well. And we're seeing those yields rise in US government bond yields. So like I mentioned tonight, we've got Jerome Powell speaking, probably going to mention the stagflation side of things. Tomorrow we've got our own RBA meeting minutes for the last RBA meeting. In the statement for the last RBA meeting, where they did cut interest rates, the statement said absolutely nothing. So hopefully there's a bit more context in the meeting minutes about whether they're going to cut rates in July or not. Local inflation has been a little bit sticky, but other local data has been weakening. Recently, we saw weak retail sales for Australia. We saw very few building approvals as well. And so the RBA might choose to prioritize saving the economy over sort of keeping inflation low. But that'll be interesting to see what they say in the meeting minutes for the RBA tomorrow. And then we've got Australian GDP on Wednesday. That is probably going to be, again, pretty anemic growth, annualized growth of probably 1.4%, running alongside basically population growth. And again, not looking very strong for the Australian economy. And then later in the week, we've got US jobs data on Thursday and Friday. Again, that'll be interesting to see whether the jobs market is starting to slow from the tariffs. The expectation is basically that it's going to be pretty stable, although we have seen some slightly higher jobless claims recently. So whether that shows up in the non-farm payrolls or not, it's going to be hard to say. So that'll be the week of data. And it does leave us with the question as to when the next interest rate cuts will be. So for the US, the expectation is now that the rate cuts are being pushed out further in time, later in the year, maybe even next year, as to when those rate cuts will come. In terms of those rate cuts being pushed out, they really haven't sort of weighed on the market just yet. The bullish momentum in shares remains, as I've mentioned, things are grinding higher. But I do think that there is a little bit of complacency, a little bit of sleepwalking that the US Federal Reserve will save the market if the economy takes a downturn. And even speaking with other participants in the market, they basically think that the Fed put is still in place. But like I said, the recent comments from Jerome Powell and others in the Fed have been, basically warning about the potential for stagflation. So whether that Fed put or, expected rate cuts and, ultimately if it comes to it, quantitative easing, whether that Fed put can be relied upon, I don't think it's as solid as it has been. For Australia, the expectation is we're going to see plenty more rate cuts, possibly in July, maybe, well, if they don't cut in July, probably August. Now, the July rate cut might not come because inflation's been a little bit sticky, and also we're, probably going to worsen the housing crisis that we're seeing, especially given the very poor building approval data. But regardless, the RBA kind of has to cut because, like I said, inflation is running alongside population growth, probably teetering towards a per capita recession again. We only just got out of one. And worst case is there's a chance we sort of dip towards a full-blown recession towards the end of the year as well. So the RBA may be forced to sort of cut interest rates to support the economy, even with the sticky inflation. I suspect they'll probably wait towards August, but if the data comes out pretty poor over the next 6 weeks or so, maybe they'll cut in July as well. So let's have a quick look at the charts for this week, guys. This is the Australian market. The bullish momentum is remaining. We've rallied for the past 6 weeks, but we've really slowed over the past sort of fortnight. We hit sort of, let's say 8,400 in mid-May, and since then we've traded in about a 100-point range. We've really sort of ground sideways. Prices are very elevated, and there is a lot of room to the downside, but until we see some sort of, basically bearish lead from the US or some sort of negative event, I think we're going to continue to grind sideways to maybe even slightly higher. I do think the market is sleepwalking though, because any upside is likely to be quite small, but any downside could be substantial. So something to watch out for, a slight grind higher or potentially a substantial fall to the downside. If we have a look at the US market, it's a pretty similar story, where they've also been on a nice upwards movement for the past 6 weeks. They also stalled out in the middle of May, and since then they've also been going roughly sideways. They have their own sort of uptrend line, probably a more clear uptrend line than our own, and they did dip below that line on Friday before grinding higher to finish just on the line. We do see US futures a bit lower at the moment, so they will be testing that line again today. If they can break lower, probably heading back towards 5,800. And if they hold the line and push higher, they need to go above 59.75 before they start looking towards the all-time high. But again, for the US market, a similar story, probably a bit limited to the upside is what the technicals are suggesting, but the fundamentals are suggesting there could be substantial downside. The only thing saving markets and the only thing propelling markets for the last 12 months has really been US government money printing, and that does remain in place. The big risk is whether that translates to inflation and a sovereign debt crisis. So those are the things to watch. Those things aren't necessarily short term, so that's why I say probably more likely to see a grind sideways to higher in the short term. We'll wrap it up there for this week. Hopefully you guys enjoyed. If you did, click like, click subscribe. Sorry it was a bit of a chaotic one, but there's plenty of chaos to cover. That's the nature of things at the moment. So yeah, I'll hopefully see you guys in the next video as well. Bye for now.